Hello there and welcome to the latest episode of Nestegg's Meet the Managers series. Now look, although COVID-19 has given us some actions that have actually rewritten history, I do want to talk about Black Swan events and how really we can understand how some of these aspects with the Black Swan event are taken to be considered, but also they will happen again. It's almost certain. I'm joined today with none other than himself than Philip Bryan, who is the Managing Director for Trilogy Funds. Philip, it's been a while since our last podcast, but look, it's great to see and hear you today. How you been?
Yeah, great. Thanks, David. Good to see you.
Good man. And I think, look, for anyone who, extra points if you have heard Philip across on our podcasts, but I think it's a really, really interesting time of the year to have these conversations with you because the year that we've had, or at least what's happened, has been a massive, massive change in the industry, in the wealth space, for investors, for everyday Australians. What I will note is that Black Swan events will happen again. But one thing that probably hasn't changed as much are the basic rules of investing. So I just want to get your quick take on terms of the basic rules of investing and how they still apply to this day.
Well, David, it's happened all through my life and I've experienced a few of them. They occur basically about once every 10 years or so. And what it goes to show is the importance of diversification. And the other important rule is don't panic.
Yeah, absolutely. Look, Phil, you said that's exactly right. And it's one of those things where we always come back always again and again around how these conversations really don't change. It's diversification and of course keeping in the market throughout these moments. Reactivity is something which sometimes can mostly affect the productivity, in my opinion, of how your share portfolio, for example, or any of your investment portfolios would act. One other thing that I wanted to get your take on here was really an idea of we've seen this huge divide across from the economic factors. We've had massive stimulus packages which have been injected into the Australian and global markets. But alongside that, we've seen this clear divorce between the equity market and, of course, the economy. The one thing that I think I want to know, and a lot of listeners out here, will be how is the property market per se, in terms of different types of properties, actually phased or been phased through this period as well?
Well, the government and the RBA have actually been very kind to property investors. We've seen that obviously with the RBA dropping rates down to 0.1%, which of course we haven't seen in human history. And the other thing, of course, is government stimulus. So overall, it's been good in terms of residential. That's flown through in terms of clearance rates. And also we've started to see price increases as well. But the one thing we haven't seen for a number of years now are actually investors coming back into the market. And of course, it's difficult at the moment if you go find a property to find something that's negatively geared. And that's particularly the case here in Brisbane. So we're gradually starting to see investors come into the market. And I suspect once they start competing with your typical owner-occupiers and first-home buyers, that's going to cause some price appreciation in the resi space. Now, in terms of other markets, one of the things that we're focused on is the Trilogy Industrial Property Trust, which is currently providing a rate to investors of around 7.8% per annum. And that has an asset spread across a number of diversified industrial property assets from Queensland through to South Australia. Now, that, of course, that type of investment has got the benefit that it's, if you look at the industrial space, it has the benefit of low Australian dollar. It's also industrial or manufacturing based. And of course, what we're seeing with commodity prices is that they've maintained quite a stable return. So that side of the market, I think, is fine. The area that does concern me is obviously ones like commercial in terms of office space. I know for small, medium-sized businesses such as ourselves, we've been back here since May. And one of the things that I struggled with is that I feel like we're the lonely people in here in Eagle Street in Brisbane because you look around, there's no one else around. And what I've found talking to, the large accounting firms, the large banking firms, like a lot of them are still absent. They're still working from home. And I suspect they may have that philosophy, that work practice going into the future. And it's probably more the small, medium-style businesses which are now back in the offices. So how that plays out in the future is an issue. And I wonder about large-scale commercial developments in the city. I can't help but think that people will revert to the norm. It's difficult to say. The other area which is a concern, obviously, is retail. And one of the things we don't have is much exposure to retail. Particularly in CBD areas, I really think that with growth towards online shopping, etc., that's going to undergo a transformation. Of course, with neighbourhood shopping centres through COVID, they've actually had a resurgence. But of course, I'm just not too sure how that will pan out in terms of behaviour going into next year and beyond. I can't help but think that this move towards regions and also move away from the cities may actually revert more to the norm after a year or so.
Yeah, that's a really interesting point you made there. I think the interesting takeaway was, look, interest rates are at historic lows, and they have been for a long time, but they keep getting lower and lower. Normally, it is an indicator of how that could increase potentially more buyer-occupiers, certain property markets in the residential space. So it's interesting to see how that will have a longer-term effect. But also the other side, like you said, with the commercial side, that vacancy rate could be a concern. But like we said, we're in an environment now which is very new. It doesn't mean it's going to be sustained, and that's something which I think is one thing to keep one eye on, and the other is to see how the market really reacts going forward. Like we always say, is timing the market is going to be tricky, but timing the market, especially with even how different economies of scale work, or if people are working from home, or if people are going to be back in the office, that's something which, of course, is going to be more monitored as time goes on. So you can't quite look into, even though we wish we'd have one, the crystal ball effect doesn't really apply here yet, because it's so new. You know, this has never happened before in the history of humankind. But yeah, it's interesting to note that. One of the other things which I thought was definitely worth mentioning, and this is a big topic, or I suppose it was, back in October. Now, in the markets in general, equity markets, they're very, very susceptible in October to be known as the month of volatility. Now, I say that with a pinch of salt because we had the election, which was also an extra stir of the pot. So we did have an idea in terms of, look, President-elect Biden's victory win across from there, and taking away the short-term discrepancies of, you know, when his policies are going to be taken in is very important for investors who don't like surprises to have a very clear and indicative way of how old policy will be transitioned into the new policy. Now, we can take that into another conversation itself, but what I'm quite interested to know is, in your opinion, a Biden policy or a Biden term, would that have much of an effect in terms of how that would actually affect the Australian markets, the Australian property cycle, and really a bit more around how that really could be a very different picture to what Trump had?
Yeah, look, it's a good question, David. I was watching a Bloomberg program the other day, particularly interviewing a Republican just on that particular point. And, I think the Goldilocks scenario for American investors is a Biden victory, but Republicans still controlling the Senate. And so as a result, there might be some fetter on the taxation reform, which Biden was talking about. But obviously that has flow on through to Australia, particularly America being such a major trading partner to Australia, and also its effect on commodity prices worldwide as well. And I think a Biden victory at the end of the day is going to be quite stimulatory for world economies. And I've got to say, I think I'm quite optimistic as a result.
Yeah, no, interesting. Good to hear. And I think, just to cap off the questions that we've had today, and we could talk about this all the time. Unfortunately, we have got a limited amount of time here as well. But to understand, I think, where Australia is known for its resilience in its economy, I know that we've had, we have dipped into a recession for the first time in almost 30 years, which is a huge accolade to have in any economy. But there is that level of resilience still. And one thing I think is interesting is what we've seen across overseas and here are unprecedented measures for softening ways to have any economic impact, any economic blows, such as quantitative easing, stimulus injections, all of these things that essentially have been laid out across the year itself. I do want to know, do you think we're taking from tomorrow? And what I mean by that is, are we making an impact which will essentially have a bigger impact in tomorrow's investing world and general economy?
Well, I guess the point of that question, David, is really how much debt are we prepared to take on? And I've got to say, one of the things I found interesting is hearing Treasury say that the interest which is currently paid on the debt as projected for this year and next year is actually less than what it was for last year. And if you talk to the economic pundits about what the RBA is thinking, they're effectively saying that they expect low interest rates to be here for about 3 or 4 years. I wonder if there's a takeaway, and that is that one of the things the RBA said is that they're no longer concerned about asset bubbles. They're really focused on getting unemployment down, is number one, and also having a target inflation. Now that runs completely against the trend of I guess, me when I was growing up. It was always inflation, and really unemployment was quite a secondary thing. I mean, I got to say, I grew up in the days when unemployment was 10% plus, and we had interest rates of 18% at its worst back in the 1980s. Where I see the future heading is that with asset inflation, the argument is that people will be more confident. So when we see houses increase in price, they'll be more confident to borrow against that increase. They'll be more confident to go out and perform renovations and the like. Perhaps they'll also feel more confident in terms of buying other goods, and as what we're seeing in terms of people buying camper vans and new cars. Try and buy a second-hand car at the moment. They actually seem to be going up in price. So we are seeing some price increases occurring in other assets. And I can't help but think that will be stimulatory to other businesses. Now, obviously, some businesses have hurt really, really badly. I know when I walk out the office and you look around, you see how many coffee shops have closed down. Well, that probably represents someone's house, which they've had to sacrifice in terms of doing that. And of course, people have lost their jobs as a result. But on the other hand, with these stimulatory measures, and people, and I know, the adage is that the wealthier people have a propensity to save, but I can't help but think that people will be buying assets, and that will be stimulating employment at the end of the day. We could actually be in a position, and this comes back to black swan events again, where we see outlier events occur, which actually causes inflation to rise again. Now, economists are sort of panning that theory at the moment, but we've seen it before in the 1970s, and that was where the oil price just exploded overnight when OPEC came into being, and we had the oil crisis and ultimately inflation. It may not be oil this time, but it's possible that something else will occur. It could be an explosion in wages, for example. We haven't seen that for many years, but that could actually simply through lack of qualified people, overstimulation in terms of demand, that could actually cause prices to rise in that sector, which could lead to inflation. So that's probably the takeaway I've got as something to watch out for, probably over the next 4, 5, 6 years.
Yeah, absolutely. Look, Philip, that's a really good take. I think the interesting thing there is looking at the assets and how they've appreciated over the time is just testament to, and I love when we catch up because we talk around the same key thematics or basic learning steps that people sometimes forget. Whenever these black swan events happen, people run out and panic and they lose all kind of sense of reality. The real fundamentals here are stick to what you know and stick to what works and what's been proven in historic values as well. So always really good to catch up, Philip. Once again, really appreciate your time today.
Thanks, David. Great to catch up. Great to see you. All the best for Christmas.
Thank you very much, and to you too. And for you out there, thank you very much for tuning in. It's great to hear from you and see you watching this episode. If you did enjoy it, you can also check out more information below. You can follow what Trilogy Funds are up to in the links below too. And until next time, have a lovely Christmas and I'll see you next year.